Hi there, this is Rob Hanna. I'm the founder of Overnight Edges. You may also know me from my other website, Quantifiable Edges. Over the next few minutes, I plan to give a brief overview of overnight trading, some history behind it, a little about my involvement over the years, the growth in overnight trading, and why you may want to consider adopting an overnight strategy yourself. For you to read the following disclaimer. Some of what I'll be presenting is based on back-tested historical data. While I use historical data as a large factor in my decision making, there's no assurance that any backtests you do will produce comparable results in the future. Trading is a risky business. Okay. So let's talk first a little bit about the impact of the overnight session on stock prices. The New York Stock Exchange has regular trading hours 5 days a week, 6.5 hours a day. That means during the 5-day work week, the market is closed for regular trading about 2/3 of the time. If you add in weekends, the market is really only open less than 20% of the time. So it's not surprising that most market-moving events occur when the market's closed. Many of these events are planned events, such as earnings releases, which typically happen before the open or after the close of regular trading. Many economic reports, like the monthly employment report, also happen outside market hours. And of course, happenings in Europe, Asia, and other parts of the world will often occur when the New York Stock Exchange is closed. Both institutions and professional day traders are keenly aware of this, and they do an awful lot to avoid or offset perceived overnight risk. What many of them don't realize is the substantial amount of premium that they are paying to offset these perceived risks. Overnight traders look to make money by collecting this premium and absorbing some of the perceived risk. By using historical probabilities, overnight traders can better evaluate the risk-reward available. This allows them to take on the risk under circumstances which have historically been shown favorable to do so. Historical probabilities are also useful in determining situations where risk-reward is skewed so greatly against overnight long exposure that a short position could be justified. Let's look at some historical charts to better illustrate what I'm talking about. This first chart is of SPY, the ETF that tracks the S&P 500. Commissions and slippage are not included. This chart assumes that you own SPY from the 4 p.m. closing price until the market opens at 9:30 a.m. the next trading day. It goes back to 1994, which is the first full year that SPY traded. It simply looks at holding one share overnight, which better allows us to measure the total points gained and lost over the years. What you can see is that the upslope has been fairly consistent, with only brief dips during the 2000 to 2002 bear market and the 2008 bear market. In fact, as noted on the chart, 2001, 2002, and 2008 were the only years that did not show net gains during the overnight session. For the entire history, from 1994 through June 2012, SPY gained a total of $183.86. And this total does not include an additional $32.93 of dividends that would have been due and payable to overnight holders. Since SPY ended 1993 at $46.60 and closed June 2012 at around $136, you can easily estimate the net results of the next chart, which is going to look at holding SPY during the day. So very much like the last chart, we're looking here at owning one share of SPY. But in this case, we only own a share between the 9:30 a.m. opening price and the 4 p.m. closing price of the New York Stock Exchange. The net results here would have been painful for most traders to endure, to say the least. During bull markets, we've generally seen either a mild upside inclination or sideways chop. During bear markets, the day session has been horrid, as traders use the opportunity to liquidate positions and sell down the market. And just as remarkable as the total net loss over the years is the fact that not even half the years would have managed a net gain during the day. These two charts scream opportunity. I first ran these two charts in 2004, and doing so got me very excited and led me on a long journey that has finally brought me to open the Overnight Edges website. So here's kind of a timeline of my activity, research, and product development associated with my overnight trading work. I won't go through it in great detail here, but you can feel free to see the About section of the site for a more complete overview. The takeaway here is that I've been involved with this concept for nearly 8 years, and I've done a lot of work not only uncovering these edges and calculating the odds, but also developing tools to take advantage of the edges. After a long journey, I'm finally ready to make the edges known and the tools public. While the concept of overnight trading may be new to some of you, I'm far from alone in studying it. After stumbling upon it myself in 2004, the first research I saw to back my findings was published by Larry Connors in 2005. When I saw his article, which showed charts similar to the ones I showed earlier, I thought for sure the floodgates were about to open and soon everybody would be talking about it. And many have. Bespoke Investment Group has discussed it on their blog. So have other noted bloggers like Woodshedder, Michael Stokes, and Dr. Brett Steenbarger of the now dormant TraderFeed blog. In 2009, Peter Berezin of Goldman Sachs sent a study about overnight returns to clients, and this study was featured in an article on Bloomberg. And the most recent study I've seen was written by Eric Skyba of TradeStation Securities in the February 2012 Stocks and Commodities magazine. But what would make someone want to make the leap from viewing overnight tendencies as simply interesting to actually using them to trade? There's a lot of reasons I can think of, but here's a few. As I showed, there are substantial edges that are available only in the overnight session. And with interest rates near zero, your money's no longer working for you overnight. My experience has been that overnight edges have typically been more consistent than many day trading based edges that I've tried to exploit. Another nice aspect of overnight trading is that it doesn't require you sit in front of the screen while you're in a trade. In fact, for ETF traders, it's not possible to do so. Personally, I hate sitting in front of the screen watching a trade, and I find this very appealing. I've traded both ETFs and futures using overnight strategies. Futures, of course, allow you to adjust or exit your position during the overnight session. For me, that's done using stops and targets. I do not typically sit and watch the position or move these stops and targets during the night. Of course, perhaps the greatest advantage is that overnight trading allows traders to diversify their strategies, and it provides opportunities to profit that otherwise wouldn't be available. I'm not the only one who sees great opportunity in overnight trading. This chart shows the growth of overnight activity since 2000. Institutions have been ramping up overnight activity dramatically over the years. Overnight liquidity in E-mini contracts is now over 200 times greater than it was 12 years ago, and it's continuing to grow. Of course, most trades don't require great overnight liquidity in order to successfully make money. Overnight edges are all designed to take advantage of this time, but taking advantage of the edges did not require overnight liquidity. This is because the executions typically take place at the two most liquid times a day, the open and the close of trading. So people that trade ES or SPY will be trading the most liquid instruments in the world at the most liquid times of day. Who can benefit from adopting overnight strategies? Well, the obvious answer is day traders, who are typically 100% in cash each night. An overnight strategy could provide additional gains and possibly dampen portfolio volatility while still allowing them to allocate the full amount of their accounts to their day trades. I believe system traders who are accustomed to following strict rules and guidelines may also find the odd sheets and the overnight edges approach very appealing. Much of my trading is swing-based, which will often leave me sizable cash positions in my portfolio overnight. Both swing and intermediate-term traders could find additional opportunities by expanding their strategies to include overnight trading as well. And these days, we're really talking about any trader that wants to make more than 0%, or slightly above, on their capital when it's not invested overnight. So nearly everyone could potentially benefit from this. There's a lot of information either already on the Overnight Edges website or that is going to be released over time. I invite you to explore the website, read the FAQs, watch the educational videos, and follow the blog. And of course, I hope you decide to join and are able to reap great benefits from the ideas, edges, and historical data. I aim to build a terrific knowledge base of overnight edges here, and hope to also instruct and help traders take advantage of that knowledge. Thanks for listening, and good trading. Bye-bye.